Well, John referred there to the eggheads, as he called them, gathering at Jackson Hole to deliberate. Jerome Powell leading the way, of course, with the brightest brains. I'm not sure if Matt Maley counts as an egghead, but he's certainly the brightest brain, and the chief market strategist at institutional trading firm Miller Tabak+Co. Matt, good to see you. Welcome. What's the market sentiment, do you think?
Well, you know, it is funny because I think, as John had mentioned during that, when you were talking to him, that there was a sudden change late last week and early this week that thought that would go 25 basis points, now suddenly 50 basis points. Now, we don't see that very often. In the last decade, the Fed has been very good about targeting exactly what they're going to do. If we get a surprise, it's kind of from the guidance that the Fed chair gives in their press conference. So now for the first time in a long time, there's some questions about how big it will be. I think it'll be 25 basis points, and probably with some sort of a, hey, we can go much more aggressive if we need to, and the data dependency thing will be a big play. So, but the lead up into what the market has done over the last 6 months, leading into this decision, could have a big impact on what happens in the markets.
And what do these current economic indicators say about the state of the U.S. economy?
Well, I mean, as John had mentioned, we saw retail sales recently, just yesterday, and those were strong. This morning we had housing starts, which is a very important number for the housing industry, and which, of course, is very economically sensitive, and that was better than expected. But we have had some, obviously some weaker numbers across the board. There's no question the economy is weakening right now. And the big thing is, the Fed has been saying for a while, we're now changing our focus from inflation to employment. Well, the one thing is, what are they hearing behind the scenes? Because companies get a lot of pressure not to announce layoffs right in front of an election, but they may be hearing some things about that there'll be some of those layoffs announced shortly after the election. So it's a situation where we're kind of teetering here we're definitely slowing down. If it accelerates because of a turn down in employment, that's going to be a big issue for the Fed and for the markets.
Let's just explore the election a little more. It's the economy, stupid, as someone once said about a previous U.S. election. How key is the performance of the U.S. economy and business now in these final weeks leading up to this U.S. election?
Well, it's going to be very, very important, and it always is. I mean, the one thing is that the economy is doing well. I mean, the stock market, is basically very close to an all-time high. The Dow Jones Industrial Average did hit an all-time high just in the last few days. So that's good. But the problem is the stock market has also rallied 14% since April, and the bond market, we've had yields go from 4.8% to 3.6% since April. So the last 6 months, things are looking pretty good in the overall marketplace. But the economy, and for the rest of, for the general public, people who don't necessarily own stocks, it's not so good. We have more than 60% of the people in this country live paycheck to paycheck, and that is wearing on people no matter how good the stock market might be doing.
There's this lag, isn't there? I mean, you put your finger on it. I mean, things might be looking good on the big, broad picture stuff, but folks do not feel it in their wallets and their purses.
And absolutely no question. And one of the things is that even though inflation has come down quite a bit, inflation measures the rate of price increases. It doesn't say prices, inflation coming down doesn't mean prices are coming down. It just means the rate of increases are going up. So although gasoline prices and such are lower, food prices and many other areas are still, are plateaued instead of rolled back over. And so it's still pinching people, everyday Americans quite tough in their pocketbook. And that will be at the forefront of their minds when they go decide, make their election picks.
Okay, well, let's look far beyond the election. Let's look long term. What do you anticipate the U.S. Fed to do for the next 12 months, say?
Well, I do think with the slowing of the economy, I think they're going to be cutting, I'm not going to say aggressively, but they'll be cutting, I think, for the next 12 months, and it will spill over into 2025. That's going to be important because, you know, the stock market, when rates are going down, that's usually good for the stock market, unless, of course, it's, you know, signaling that we're going to fall into recession. You know, people were calling for a recession a year ago. That never took place. Now almost nobody's calling for a recession. But the key thing is that the markets are pricing in kind of a best case scenario. And, you know, we look at, you know, last year we had zero earnings growth in the U.S., and yet the market rallied 25%. Now we're getting good earnings growth this year, but since they took so much from last year, the market is very expensive. So we're going to need this economy to do more than just avoid a recession for the stock market to go a lot higher. We need the economy to pick up quite a bit. That might be difficult to do with the backdrop we have right now.
Matt, good to see you. Thanks for that. Matt Maley, Chief Market Strategist at the institutional trading firm Miller Tabak+Co.